Trading algorithms controlling commodity futures responded to recent inflation data by liquidating positions, causing spot prices to plummet. This was an automated response, a computerized overreaction. Yet at the exact same moment, Samsung SDI, the battery manufacturer supplying electric vehicles for BMW, Stellantis, and Rivian, announced final production specifications for their S-line batteries. News outlets are focusing on the impressive features, charging in just 9 minutes and delivering 900-mile range. However, they're overlooking the most crucial detail, the factor that transforms a 1.1 billion-ounce supply shortage into something far more significant. The critical component in Samsung's revolutionary solid-state battery isn't lithium or nickel. It's silver. And we're not discussing trace amounts for electrical conductivity. This represents a fundamental transformation in battery technology that elevates silver from precious metal status to critical energy infrastructure material. To grasp why this threatens available supply, you must understand the dendrite challenge. For 3 decades, lithium-ion technology has been constrained by needle-like crystalline formations called dendrites that develop during rapid charging cycles, puncturing the separator layer and creating fire hazards. Samsung's solution involves a silver-carbon nanocomposite layer. Silver's lithophilic properties, its chemical affinity for lithium, allow it to immediately absorb incoming lithium ions, distributing them uniformly like spreading butter across warm bread. This eliminates dendrite formation, prevents thermal runaway, and enables the ultra-fast charging speeds the market demands. But here's the critical point Wall Street hasn't acknowledged: the physics requires substantial quantities. You need grams, not trace amounts. The mathematics of scarcity. Let's examine the numbers financial analysts are reluctant to publish, the precise calculations that transform a simple supply deficit into a market void. Currently, a standard electric vehicle like a Tesla Model 3 or Chevrolet Bolt contains approximately 30 to 50 grams of silver. It's utilized in membrane switches, battery management circuits, and solar-integrated glass. This existing usage has already created a structural market deficit. Samsung's solid-state technology changes the equation from simple arithmetic to exponential mathematics. Silver is no longer a trace element, it's now a structural component of the anode assembly itself. Technical examination of the silver-carbon nanocomposite layer indicates approximately 5 grams of silver per individual battery cell. A standard 100 kilowatt-hour battery pack, necessary for achieving that 900-mile range, contains roughly 200 cells. The calculation is straightforward: 5 grams multiplied by 200 cells equals 1,000 grams. That's 1 kilogram of silver. In precious metals terminology, that's 32.15 troy ounces embedded in a single luxury vehicle's chassis. For perspective, that represents a complete tube of silver coins plus an additional half tube melted and integrated into every vehicle produced. Now scale this to global production. Approximately 80 million vehicles are manufactured annually worldwide. Let's be conservative and assume only 20% of new vehicles adopt this advanced solid-state technology by 2028. That's 16 million vehicles. Multiplying 16 million vehicles by 1 kilogram each yields 16,000 metric tons of additional annual demand. Total global mine production is approximately 26,000 tons. This single application threatens to consume over 60% of all silver mined on Earth. That leaves nothing for solar panel manufacturing, which already consumes 15% of supply. Nothing for electronics in smartphones. Nothing for medical devices, water purification, or jewelry. And critically, nothing for individual investors. We're facing a scenario where industrial demand alone exceeds total annual mine output, creating a mathematical impossibility that the current price of $61.84 cannot resolve. The only variable that can adjust is price, and it must adjust dramatically to ration remaining supplies. The geological reality. Skeptics will argue the market is self-correcting. They'll cite the principle that high prices cure themselves by stimulating production. They'll claim that if silver reaches $100 per ounce, mining operations will simply accelerate output, flooding the market and stabilizing prices. This is where economic theory collides with geological reality. You cannot print a silver mine. You cannot create or deposits through monetary policy. In the digital realm of finance, liquidity is instantaneous. In the physical world of mining, time is the constraint. From discovery to production, a new silver deposit requires 10 to 15 years on average. If geologists discovered a massive deposit in Nevada today, that silver wouldn't reach battery factories until 2040. But Samsung needs the metal immediately. The S-line is ramping production now. Demand is urgent, while supply response is frozen in a decade-long development timeline. The situation worsens. We're not merely facing delays. We're confronting crustal depletion. In 2005, high-grade primary silver mines yielded approximately 15 ounces per ton of processed rock. Today, that figure has collapsed to just 4 ounces per ton. We're literally exhausting accessible deposits. To extract equivalent quantities, operations must now process 4 times the volume of rock, consuming 4 times the diesel fuel and 4 times the water. This represents the law of diminishing returns. Production costs are escalating precisely as ore quality deteriorates. Then there's the geopolitical stranglehold. Mexico produces nearly 25% of global silver, yet the government has essentially halted new open-pit mining permits. Peru, the second-largest producer, faces chronic labor strikes and community blockades. Russia, another major source, operates under sanctions. Precisely when the silver-carbon revolution demands a 100 million-ounce supply injection, the global mining infrastructure is faltering. This creates a classic pincer movement, exploding structural demand from automotive applications colliding with a rigid, contracting, politically constrained supply chain. The inventory cushion that once absorbed these shocks has evaporated. The vaults are depleted. Only price remains flexible. The Shanghai signal. This supply crisis brings us to the critical indicator that appeared this weekend, a signal that typically precedes violent repricing across the entire commodity complex. We're witnessing an unprecedented divergence between paper prices in Western markets and physical prices in Eastern markets. Examining the COMEX ticker in New York shows algorithm-driven pricing at that deceptive $61.84. But looking across the Pacific to the Shanghai Gold Exchange, SGE, the physical heartbeat of Asian markets, reveals a completely different reality. In Shanghai, silver is trading at a premium equivalent to $67 to $68 per ounce. That's a massive, persistent arbitrage gap exceeding $5. In functioning efficient markets, a 10-cent gap is considered significant. A $5 gap signals a broken market. It screams that metal is incorrectly allocated. Bankers in New York are trading paper contracts based on inflation data and Federal Reserve speculation. Traders in Shanghai stand at the gates of Samsung and CATL factories. They witness procurement officers panic buying. They see the 1,000-gram loading requirements and the purchase orders. They're pricing the silver carbon revolution while New York still prices for recession. This creates mechanical inevitability through arbitrage. Sophisticated capital, global macro funds and industrial trading houses, recognizes this disparity. They realize they can purchase discounted silver contracts in New York at $61.84, take physical delivery, ship to Shanghai, and immediately sell for $67. It's risk-free profit. But here's the consequence: to capture that profit, they must drain physical metal from COMEX vaults. They're stripping Western strategic inventory to feed Eastern battery furnaces. This arbitrage explains why Friday's price drop is destined to reverse. The lower paper prices fall in New York, the wider the gap becomes, accelerating vault outflows. It's a self-correcting mechanism functioning like a vacuum, extracting every available ounce from London and New York and depositing it into strategic reserves in China and South Korea. When you observe divergence this extreme, it's not weakness, it's a vault run in progress. The paper price is a lagging indicator. The Shanghai premium is the leading indicator. The East has recognized that silver price models based on historical demand are obsolete. They're purchasing the future, and currently the West is practically giving it away. The hedgebook trap. If you're rushing to buy any stock containing the word silver, stop immediately. You're walking into a trap that has destroyed more wealth in this sector than any price crash. In the coming surge, not all stocks will rise with the tide. Some are anchored to the ocean floor by a financial instrument called the hedgebook. This is the critical detail separating life-changing returns from dead capital that stagnates while metal prices soar. Here's the nightmare scenario: you correctly predict that Samsung just fractured the silver market. You watch spot prices climb from $62 to $100. You hold shares in a major mining corporation expecting them to skyrocket. But they don't move. Why? Because 3 years ago, when silver languished at $22, management panicked. To secure financing or satisfy risk management, they executed forward sales contracts, hedges, locking future production sale prices at $28 per ounce for the next 5 years. Now silver trades at $100, but that company is contractually obligated to sell metal to bullion banks for $28. The bank takes physical silver, sells at market price of $100, and captures the $72 difference. The bank profits from your thesis. The mining company breaks even. The metal price appreciation completely bypasses shareholders. You must avoid these hedged companies entirely. They've surrendered upside while retaining all operational mining risk. You need unhedged pure plays, companies that refuse to sell their future. These offer operating leverage. Consider a miner with $20 per ounce production costs. At $30 silver, they generate $10 profit margin. If silver reaches $100, a 3x increase, their margin doesn't merely triple. It explodes from $10 to $80. That's 8x profitability expansion on a 3x metal move. This mathematics creates generational wealth. But you only capture that leverage if the miner is unhedged. Before purchasing shares, open the quarterly report, search for hedging or derivatives, and ensure that figure is zero. If they're selling forward, they're betting against the shortage you're backing. The recycling myth. Technocrats and environmentalists frequently discuss the circular economy. They'll confidently claim this shortage is illusory because we can simply recycle our way to sufficiency. They assert that billions of smartphones and laptops in drawers represent an urban mine awaiting exploitation. This is the recycling fallacy, and it's dangerous because it provides policymakers false security while physical inventory drains to zero. Here's the periodic table's dirty secret: silver is the vampire dust of industry. Unlike gold, used in concentrated amounts and hoarded in vaults, silver is dispersed in microscopic quantities across billions of disposable devices. Your phone contains perhaps 0.3 grams. Solar panels contain thin films. Missile guidance chips contain nanocoatings. Recovery physics are brutal. To reclaim that silver, you must collect devices, transport to smelters, shred, and expend massive energy separating atoms. Often, the diesel and electricity costs exceed the recovered silver's value. This explains why gold achieves nearly 90% recycling rates while silver's electronics recycling rate languishes below 20%. We're literally burying billions of ounces back into the earth in unrecoverable forms. We're converting precious metal into landfill waste. Samsung's solid-state battery exponentially worsens this through sequestration. When Samsung purchases 1,000 grams for a 2026 car battery, that silver doesn't return to market next year. That vehicle remains operational for 15 to 20 years. The silver is locked away, sequestered chemically until 2045. It's removed from liquid supply pools for a generation. The recycling wave everyone anticipates will arrive 20 years too late to address 2020's shortages. We're burning furniture to heat the house, and no more furniture is coming. The sovereign squeeze. Understand that the electric vehicle transition isn't merely a consumer trend, it's government mandate. The European Union, United States, and China have enacted laws effectively banning internal combustion engines by the mid-2030s. They've staked political legitimacy on net zero commitments. Ask yourself a game theory question: what happens when Ford and GM notify the White House, "Mr. President, we cannot manufacture legally mandated vehicles because silver supplies are exhausted"? Will the government respond, "I suppose we'll cancel the Green New Deal"? Absolutely not. They'll do what governments throughout history have done during resource crises: they'll seize control. We've witnessed this before. In 1933, FDR signed Executive Order 6102, criminalizing gold possession because government needed it for banking system recapitalization. In 2026 or 2030, they won't confiscate coins door to door, too messy. Instead, they'll invoke the Defense Production Act. They'll declare silver a critical strategic material essential for national security. They'll order refineries and mints: from this day forward, 100% of your silver output is allocated to strategic stockpiles for defense and energy sectors. Overnight, the U.S. Mint stops producing Silver Eagles. Private refiners cease selling bars to APMEX and JM Bullion. The "sold out" signs won't be temporary, they'll be permanent. You won't compete with other investors for physical silver. You'll compete with the U.S. military and South Korean government. Samsung represents 20% of South Korea's GDP. The Korean government will ensure Samsung gets the silver it needs, even if that means excluding every retail investor. This is when silver becomes unobtainium. If you don't physically hold it before the Defense Production Act is invoked, you'll never own it. You'll hold paper currency while industrial giants consume remaining physical wealth. The palladium precedent. If you believe this industrial panic scenario is fearmongering or that global supply chains are too resilient to fracture, study history. We have a perfect blueprint for exactly this event. It's happened before in this industry with a sister metal. That metal was palladium, and its story is the ghost of Christmas future for every silver bear on Wall Street. In the late 1990s, palladium was a boring, ignored industrial metal trading around $150 per ounce. Analysts treated it as platinum mining byproduct. Then a structural shift occurred, similar to the Samsung breakthrough. Automakers, pressured by new emission standards, discovered they could substitute palladium for platinum in catalytic converters. It was a chemistry decision, just like the switch to silver carbon anodes. Suddenly demand became inelastic. General Motors and Ford didn't purchase palladium because they preferred it, they bought it because without it, they couldn't legally sell vehicles. The market reaction was violent. As Russian supply hiccuped, prices didn't merely double, they went vertical, ripping from $150 to over $1,000 per ounce in a breathtaking squeeze. But the most important history lesson isn't the chart, it's boardroom behavior. Ford Motor Company became so terrified of metal shortages halting assembly lines that they bypassed futures markets entirely. They panic-bought massive physical palladium stockpiles at absolute market peaks. They didn't care about price, they cared about survival. Ford eventually wrote off $1 billion in losses on that hoard when prices normalized. But that's the point, to industrial giants, losing $1 billion on bad hedges is painful, but having global production lines shut down for 6 months is fatal. Samsung, Toyota, and Volkswagen face identical calculations now. They know that without silver, their billion-dollar gigafactories become worthless empty structures. They won't wait for price stabilization. When realization hits that silver carbon nanocomposite is the only path to 900-mile batteries, they'll panic buy just like Ford did. Only this time, the scale is different. The palladium market is tiny. The silver market is massive and interwoven throughout modern electronics. When palladium squeezed, it only affected catalytic converters. When silver squeezes, it affects everything from cruise missiles to solar panels to smartphones. The repricing we're about to witness will make the palladium chart look like a flat line. Industrial giants are awakening to the fact that they're short the most critical strategic asset of the 21st century, and there's no one left to sell it to them except you. The 48-hour window. This brings us to the precipice. Right now, markets are closed but will reopen shortly. It's the calm before the storm. The price on your screen is frozen at that deceptive $61.84, a ghost of last week's trading. But when the clock strikes 6 p.m. in New York, Globex electronic markets will restart, and we'll see the market's verdict on the Samsung revelation. I predict a gap up, a violent price jump where the market skips increments entirely, opening significantly higher than it closed. This isn't speculation, it's the mechanical result of Shanghai arbitrage. Asian trading desks, fueled by panic orders from battery manufacturers, spent the weekend calculating the spread. They know every contract purchased at $62 represents instant $5 profit if they take delivery and ship to SGE. When markets open, these buy orders will hit thin Sunday night liquidity like a tsunami. Algorithms that normally suppress prices will be overwhelmed by sheer physical volume. We could see silver jump to $63 to $64 in the first 15 minutes. But here's the warning, next week will be psychological warfare. Bullion banks, entities short billions of paper silver ounces, know they're trapped. They know the Samsung narrative is spreading. They cannot stop the chemistry, so they'll attempt to break your psychology. Their only remaining weapon is volatility. They'll induce financial motion sickness. You'll witness days where prices surge $3 higher followed by sudden, inexplicable $2 overnight crashes. They want you staring at charts until you're dizzy. They want you feeling drop fear so acutely that you hit the sell button just to sleep peacefully. Don't fall for it. This volatility isn't a crashing market, it's the death throes of a manipulated one. It's turbulence always felt when the pressurized cabin of paper markets is breached by hard physical demand reality. If you see spot prices drop but out-of-stock banners remain on dealer websites, the price drop is false. It's a matrix glitch designed to shake you from positions before real repricing begins. The final decision. We've arrived at the final decision point. The data is clear. Silver carbon anode chemistry is confirmed. Geological supply is terminally broken. The arbitrage gap between Shanghai and New York screams the dam is breaking. The Samsung announcement wasn't just a press release, it was the starting gun for the greatest wealth transfer in resource history. But knowledge without action is merely trivia. The next 48 hours are critical. You have the playbook, but must execute with machine-like precision, ignoring emotional noise the media will unleash. First, your physical strategy must shift from collection to accumulation. Forget numismatics, graded slabs, and aesthetics. In a shortage defined by industrial panic, only weight matters. Samsung doesn't care about coin dates, they care about atoms inside. Prioritize low-premium bars and government bullion. Secure maximum grams for every fiat dollar deployed. Second, if venturing into mining stocks, be ruthless. Audit their books. If production is hedged, they're dead to you. You want unhedged primary producers in safe jurisdictions, Canada, Australia, USA, who will capture every cent of coming repricing. I'm not a financial advisor, and this is certainly not financial advice. I'm a finance historian, and history screams that when monetary metals become strategic energy necessities, old price models don't just bend, they shatter. We're watching the periodic tables repricing in real time. The window to position ahead of sovereign wealth funds and gigafactories is closing. Once Defense Production Act headlines hit, the retail window will be sealed. You're currently standing in the brief, miraculous gap between technology realization and price reaction. This leaves one question, the only one that matters: when history books document the Great Silver Squeeze of 2025 to 2026, they'll record two groups: those who held paper receipts of a bankrupt system, and those who held physical keys to the energy future. The banks are betting you'll stay scared. Samsung is betting you won't do the math. Who's awake? If you're holding the line, if you understand the gravity of the shift from $61 to sold out, declare your conviction. Plant your flag for the algorithm to see. The banks are playing a paper game. Samsung is playing a physics game.